Amazon released its earnings for Q1 and they seem to do pretty well, beating almost all estimates. However, it is still down 15% from all-time highs and still hasn't recovered from the dip it initially experienced when Trump's tariffs were announced. So today I want to talk about the reasons why Amazon is still down and then take a look at their Q1 earnings to see how they done this quarter and if Amazon stock is looking potentially cheap in the market today. Now you might ask, if Amazon's beaten almost all estimates and has been gradually improving, why is it still down 15%? And the simple answer is tariffs and the current market condition. Put simply, tariffs, which is on everyone's mind at the moment, offers a major issue for Amazon's delivery segment of its business, as it could not only increase the price of goods in America, which is its largest market, but could also increase the cost of shipping its product across the world as trade routes get disrupted from the tariffs. Now to me, this is currently Amazon's biggest headwind, and combined with an overall decline in market sentiment, we have seen a pretty negative reaction in the stock price. But I love to see stock prices of a good business fall. So let's take a look at the numbers to see if Amazon offers significant value in the market today. So getting straight into the fundamentals, we can see here that they produced $155.7 billion in revenue for Q1, compared to $143.3 billion in Q1 2024, which represents an 8% increase year on year, which is quite impressive. Operating cash flow is the most important metric for Amazon because I believe it best highlights the growth of the core business. With Amazon constantly maintaining high capex, free cash flow is often distorted, and it means that it is really hard to value Amazon with free cash flow. And moving on to the numbers, we can see here that Q1 2025 we produced $17 billion in operating cash flow compared to $19 billion operating cash flow in Q1 2024. Now this represents a 10% decrease, which does have investors worried and is one of the reasons Amazon hasn't fully recovered to all-time highs. Looking at the trailing 12 months though, we can see that we have actually compounded at 14.8% since last year. So this might have just been a weak quarter and an outlier for Amazon, and we can see here that they still have actually produced good numbers over the past trailing 12 months. As mentioned, Amazon is a business which puts a ton of its operating cash flow back into capex, instead of using its cash flows to return money to shareholders in the form of dividends or share buybacks. They do this to fuel the future growth of the core business, as Amazon clearly believes that they can increase shareholder value more by aggressively scaling the business than paying out with shareholders. And looking at their capex for the quarter, we can see that it came in at $25 billion, which is down 9% quarter over quarter, but up a massive 67% year on year. Now looking here, we can see that CFO Brian Olsavsky said that they've been using this capex primarily to develop AWS and attempt to meet the demand of AI services, and then also in their more traditional segments, such as their transportation network, to improve the speed and cost of the deliveries. Now, one major issue I've seen many investors have online with Amazon's Q1 earnings is the fact that Amazon has seen their free cash flow shrink from $18 billion produced last quarter compared to minus $8 billion produced this quarter. And looking at their Q1 2024, we can see that they also fell short, with them producing $4 billion in free cash flow in that quarter too. Now, personally, I don't believe this is a major red flag for Amazon. I don't think it should ring the alarm bells for investors either, because as I have mentioned, Amazon consistently goes through major capex cycles, and this does sway our free cash flow figures. To put this into perspective, remember that Amazon has increased its capex spending by more than 60% since Q1 2024, and although from a free cash flow perspective this should sound the alarm, I believe Amazon has consistently been able to scale its operations very well by utilising its capex effectively, and looking at AWS and its projected double-digit growth, it looks like this time won't be any different. Looking more into AWS, it's Amazon's newest and most popular segment of its business. It operates Amazon's cloud-based service, develops their own AI, such as their version of ChatGPT, Amazon Nova, and develops their own AI chips to compete with NVIDIA, such as Trainium 2, which is around 40% more cost-effective at training AI. So it's safe to say AWS is making massive gains in the AI race, and this is reflected in their numbers. AWS has grown a massive 17% year on year, whereas their expenses, which is already a small percentage of its net sales, has only grown by 13%. Taking a look at the balance sheet, we can see that the year on year cash and cash equivalents is down 9%, which is a difference of $6.6 billion. However, marketable securities is up $16 billion, and taking a deeper look into their marketable securities, we can see here that under their investing activities, they did purchase $13.3 billion worth of new securities, and they sold and had matured securities worth $7.7 billion in the quarter. Also, all of their holdings consist of US and foreign government securities, corporate debt, and asset-backed securities. Now, inventory is up 15% year on year, and this is mainly due to Amazon's management trying to offset the cost of tariffs by stocking up on goods now so that they don't have to pay import duty in the future. And for extra context, Amazon has said that other companies in the industry were also increasing their inventory, showing that this is very much a priority across the industry. Now, the overall balance sheet is actually quite healthy, with a current ratio of 1.05, showing that if needed, current assets could pay off current liabilities. We will be using Stock Unlock's DCF calculator, and if you would like to use the tools we use to perform our analysis, go down to the description where you can receive 10% off your first year. Moving straight onto our DCF, I will be using operating cash flow as our metric because, as I've mentioned earlier, I do believe it gives us the clearest image of Amazon's core business by taking out its capex. Now, I will be using a metric growth rate at 15%. Now, I do believe Amazon could beat this by a couple of percentages. I think it's better to have a conservative one just to maintain a good margin of safety. So I will keep 15% just to be a bit more conservative. Amazon's dilution of shares has slowed down, so I will lower this to about 1. But I won't lower it anymore because Amazon does still see a fair bit of dilution, so it is safe to say that they will still see some in the future. And for the price ratio, I'm going to put it at 22, which is below the 5-year average of 24, but is above 20, which is what is currently at in the market today. And all of this leaves us with a fair value of $275, which is 27% below the current market value. And this could return investors 15% year on year if Amazon can produce the figures that I am expecting. I do believe this has quite a bit of margin of safety, and they could even return more. But with this margin of safety, I do believe investors could see 15%, even if Amazon has a bad year or for whatever reason. So overall, Amazon has had a good but not great quarter and has been able to grow and scale its new and existing segments of its business. And I believe the business is doing great. In terms of Amazon stock, I do believe that Amazon is looking like an extremely attractive buy in the market today. And since our last Amazon video, I have actually been adding Amazon to my portfolio because I do believe it was just looking extremely attractive. But that's it for today. It was a shorter video than usual, but I just wanted to recap on Amazon and how I'm looking at it as an investor. But if you enjoyed the video, please leave a like and subscribe, as there will be a lot more content like this in the future. And if you have any questions, feel free to leave a comment down below. Or if you have any recommendations on what videos we should do next, please leave a comment. I'll be sure to respond.